Hello and welcome everybody. Welcome to a new event brought to you by Real Estate IQ and Express Capital Financing. Just want a quick word about our host, Real Estate IQ. Our mission is to help one more person to win, specifically through deal finding and deal making. One of our best sellers are our off-market leads, where we provide pre-foreclosure properties to investors. These are, a very, very lucrative type of motivated seller leads because these sellers either need to sell their house or risk losing their house in the upcoming foreclosure auction. Many different types of leads as well. If you want to dig into that a little bit deeper, just feel free to send us a message, and we're more than happy to give you a presentation. Now, speaking of deal finding and deal making, we like partnering with expert speakers, the folks that are actively doing deals on the market today, to bring you these topics to continue to upgrade our knowledge. We understand that knowledge is one of the most crucial part about taking action, or putting things into action, obviously aside from taking the action itself. And we love and we really enjoy bringing these events to you on a regular basis. Some of you may be wondering, okay, I love these classes. How do I get into some of these topics in depth, right? Speaking of making deals, one of the biggest kind of action taking type of deals is the fix and flip type of deals. And we have created on-demand workshops that we go into in depth, where you can instantaneously access these classes now. Let me advance my slide here. We have our fix and flip workshop, and just want to give you guys a quick word that we have a limited time, limited seat, $50 off, where you can sign up for the workshop. Tons of experience. Even one lesson that you learn from this is going to be worth thousands of dollars. So, tons of value here for you to take advantage of. If you want to move forward, just scan this QR code or send us a personal message, and we'll direct you to take advantage of this promotion. Now, without further ado, I want to introduce Max. Max is a very experienced investor and loan officer, and we have partnered together. Welcome, Max. How are you? You're on mute right now.
Sorry about that. I said thank you so much for having me, Steve. It's good to be here. How's everything with you?
And welcome. And we look forward to learning more about Express Capital Financing, and also how to qualify the DSCR loans. And so without further ado, Max, please take it away.
It would be my absolute pleasure. So I'm going to go ahead and share my screen real quick. There's one thing that I definitely want to highlight, which Steve just said, which was, in order to take action, you need the knowledge, the know-how. A lot of people will ask, where does the confidence come from? The confidence comes from you doing the work and understanding and gaining the knowledge. And so if there's one thing I can do today, I hope, is to give you guys a little bit of confidence in some of the products that are out there for you, how you can use them, how to understand them, so that you can be more confident to take that next step in your next investment property. So today's conversation, today's topic is the DSCR loans, the product, and we're going to talk about how it's used and all that other fun stuff that go along with it. Just to introduce myself for a moment, my name is Max Chera. I am a co-founder and managing partner at Express Capital Financing. Pretty much I've been introduced to real estate at a very young age, where I've had experience at a brokerage in Brooklyn, in Texas, in Austin, Texas specifically. We mentored agents, fix and flippers, investors, and still getting involved in it and trying to just help, a new investor a day is kind of the goal. So today's conversation, as I mentioned, is going to be about DSCR loans. We're going to cover what it is, what the difference is between a DSCR and a traditional investment loan, some of the characteristics that come along with a DSCR loan, the benefits of using one, how to qualify for a DSCR, which is the big conversation, I'm sure, the common pitfalls and how we can help avoid them, how to calculate DSCR, and what that means for, am I not showing the full screen? If I'm getting cut off, Steve, I guess maybe just let me know and I could be happy to show it. How to calculate the DSCR, portfolio loans, and how that works to get involved also with the DSCR, and why work with Express Capital Financing. So what is a DSCR loan? A DSCR loans, so DSCR stands for debt service coverage ratio. Now, the biggest thing to understand, I guess, is that it's really all about the way that we underwrite the loan versus a traditional one, right? What are we looking at? So when we're doing a DSCR, it's more of an asset-based loan where the approval is based off the property's cash flow, not your personal income. So a DSCR allows for investors to scale their portfolios faster. It doesn't have any strict income verifications. We don't ask for W-2s, tax returns, or any of that. What it comes down to is, can the property afford itself? Is this a good investment property, or is it not a good investment property? And that's how we're usually going to, that's pretty much a lot of what we're going to cover today. So now, why were DSCR loans even introduced to the market? Why was it necessary? So it created a way for real estate investors to qualify when they couldn't qualify based off their personal income. Traditionally, a bank is going to look at your income and say, okay, you can afford X amount a month in a mortgage. Even though this property is adding to your income, they're not necessarily looking at it that way. They're looking at what can you afford as a person. So eventually, if I make, $200K a year, eventually I'm going to cap out as to how much I could afford and how many properties I could have on the books with a given bank. Banks also require, they don't really focus on the actual property itself. Again, there are some basic qualifications as far as, is the property appraised for the value we're purchasing it for, and things of that nature, but they're not really looking at the asset to say, is this a good investment? They're looking at it to say, hey, can Jack and Jill afford this property? Now, it's also ideal for the self-employed investors, right? And again, I don't want to say most, but a lot of investors are not your traditional 9-to-5 guys. Yes, you have some of them as well where they work during the day, they use that income, they want to invest it and make money on it. There's definitely a lot of them out there. But a lot of investors, especially in today's market, the more I talk to them, they're more knee deep in the game. They're like, I am not employed. My employment is to find work every day. And the way I find work every day is by finding properties, whether it's a fix and flip, whether it's my next rental property, whether I'm doing the BRRRR strategy. They're getting involved in it. And that is their day to day. They live the life of an investor. And with that being said, they don't necessarily have a personal income. They have rental income that comes in their way. They have profits that come in from their fix and flips. So this is ideal for those self-employed investors and those that are looking to also scale their portfolio. Additionally, also understand that, a traditional, and I know I'm skipping a little bit and kind of talking about the traditional loans, which we'll cover again soon. But traditionally, a bank is not going to allow you to have more than 5 to 10 properties on their books at a given time, depending on the bank, the person, but generally those are about the numbers that you're looking at. So if somebody is looking to really build an empire for his family and for his kids, they're going to get capped out with a bank at a certain point. Now with DSCR and products in the private lending space, you're not capped as to how many properties you're able to have on the books at a given time. So why did DSCR loans become so popular? If you haven't figured that out yet from all the different tweaks and why it's good for investors, there needed to be an easier qualification process, which did not require tax returns, W-2, or any other types of income verification. It's also a much faster and more flexible product, right? So investors who need to close fast, usually if you're getting a good deal, the caveat to that is the seller is wanting you to close sooner rather than later. And that's the benefit that you're bringing the seller and why they're willing to sell it to you for less. you need to close quick. And not only do you need to close quick, but you want to be able to close efficiently. You don't, more often than not, investors have a lot of things going on in their day. They're dealing with contractors if they're a fix and flipper. If they're 9 to 5 and investing on the side, they have a job to do during the day. They don't really have time to focus on all the little details that, a bank is normally going to require. So it's a much more efficient process and much less documentation that's actually being used in order to underwrite these loans. It's also great for scaling. Again, there's no limit on the number of properties that you could have on a lender's books. And it's also a lot more investor friendly when it comes to terms. So, and most people will probably have noticed that, DSCR has been around for quite a while. It's not something that I would say has been, in our market for 4 or 5 years, but in the last 4 to 6 years now, 5 to 6 years, it has become extremely, extremely popular from every angle of it. So investors are becoming more familiar with it. They've used it once because they needed to close quickly, and now they're realizing, whoa, I should be doing all my deals this way. Banks are trying to copy it, but they can't because they have a lot more red tape around themselves. So they may have a product similar, but it's still not getting the flexibility and the speed that a private lender can achieve. So you'll probably hear it now in most real estate conversations, whereas 5 years ago, I think it was a lot more in the hush and we had to really educate people on it a lot more. So I think that now more often than not, people know about it. Today, what we're going to do is really get a dive into it to help you guys understand it at a deep level and how to really underwrite your deals at the same time. So a little bit repetitive, but we'll go into it regardless. The DSCR loans versus your traditional investment deals. So a DSCR loan uses the property cash flow instead of your personal income. It's also a lot quicker to close. We can normally close within 3 to 5 weeks versus a bank, which is going to take 30 to 60 days. We also, and this is a really, really big one, by the way, that has just been introduced to the market. We do not even need to do a hard credit pull to close a DSCR loan. We can close your DSCR with just a soft pull. Now, that is massive for people that are also looking to buy multiple properties in a given year. People don't want to put a bunch of inquiries on their credit report for every time they're buying a property. They know they qualify. They have a relationship with the lender. Why do we have to keep doing that? Now, again, a credit score is very important when it comes to a DSCR product. We are looking at your credit score. That is one of the two things really that an investor brings to the table is their credit score and liquidity. And we'll get into both of them. But we don't need to keep doing hard pulls on you where we're hurting your credit more than we're actually helping. There's also no limit on the number of financed properties, unlike a traditional bank. So I think we covered now a lot of the differences, even some of the characteristics, which we'll go into right now, have probably been covered, but we'll go into it now in more of the numbers perspective. So when it comes to a DSCR product, we're traditionally going to lend at 100,000 to 5 million. Now these are for normally your 1 to 4 unit properties. Now we do also offer products for the 5 to 8 and 5 to 12 unit properties. And then there is also now a commercial product that is made for the 12 and above units. So numbers do change slightly. We're going to focus today on the 1 to 4 space specifically. But just know that if you are, a little bit more experienced and you are looking to do commercial assets, there are products for you that we at Express Capital Financing have that are extremely similar. They work based off the asset. They work based off of just your credit. You don't need the income verification, and we will do other types of other property types. But we're going to focus today specifically on the 1 to 4 space, since it's probably the easiest to break down, and from there on, there's a lot more questions in commercial. So the loan amounts range from 100K to 5 million. We don't want, we want to deal with the typical, 1 to 4 unit rental properties, condos, townhomes. We could even do short-term rentals. The only difference with short-term rentals is that you do need to have 1 year of your rental history, right? So if I purchased a property today, turned it into an Airbnb and wanted to finance it tomorrow, I would not be able to use the income of the short-term rental. We would have to use the fair market rent for 12 months. But if I had my Airbnb running for 12 months or more, I'm able to use that information in order to get a better deal for my Airbnb. We offer up to 80% LTV for purchases and 75% for cash out refinances. Now, if it's a rate and term, we could still go up to 80. So specifically, whenever it's a cash out refinance, it's capped at 75%, which is very high LTV. We're leveraging your property at 75%. Typically speaking, if just in case if there's anyone new on this channel that maybe might not understand, the LTV is the percentage of your value of your property that we're willing to leverage. So if your property is worth $100,000 and you wanted to do a cash out refinance, we would lend up to $75,000. Now, the minimum credit score requirement is a 650. Now, the better your score is, the better deal you're going to get. We have put together multiple different products where I can get the max leverage with the 650 with a higher rate and still achieve that max leverage. But if I'm a 680, I can get that same leverage with a better rate, or maybe I get into a better product and take less leverage. So there's a lot of different ways for us to creatively structure a DSCR loan. The key thing that I want to highlight again is that we only do a soft pull. There's no hard credit checks needed for a DSCR. Another thing to highlight when it comes to credit, and this is something that you should be taking into consideration when choosing who you decide to work with as your lender. At Express Capital, we take pride in really not just getting the loan done, but helping our clients achieve the best deal possible. So yesterday actually is a perfect example. We had a deal where the borrower needed 75%. His credit score was 4 points shy of getting the better leverage with a better rate. And we told him, look, we ran a credit simulator, and if you pay off a card by this much money, $600, you send me the updated balance, I can get it updated on your report. We'll have the score that we need to get you the better rate. He paid $600 and he saved thousands of dollars a year on his rate. And we were very happy we got it done in 24 hours. Now, do they always happen in 24 hours? No, but we do help our clients make sure that we're putting them in the best situation possible. And we're always going to look through the scenarios and explain to you if there's an option that can be done that would help you out. We covered the eligible property types, which are the 1 to 4s, the rentals, short-term rentals. And again, the biggest piece of all of this is that no tax return or W-2 is needed for a DSCR loan. I don't think I have it listed in here, so I'm just going to speak it out real quick. The types of what do we need to fund the DSCR loan? We need a lease to show that the property is rented. Now, we can fund vacant properties. Generally, if you've just finished the renovation and you put it on the market, you just had a tenant leave. We don't really want vacant properties that have been vacant for a while. So there should be a good reason behind why it's vacant today. And in those scenarios, we won't ask for a lease. We'll just look at the appraisal and it'll tell us what the fair market rent for that property is. We'll need the entity documents, right? Because we want you to be, even though we can fund it in your personal name, most 99% of our deals, probably even higher, 99.99 are done in an LLC, not just because we want that, but also because the borrowers want that. It's always safer. Again, speak to your attorney. Don't take my word for it. I'm not an attorney. I cannot really advise you on that. But you will see that there are a lot of benefits to doing it in your LLC. So we'll ask for your entity documents. We'll ask you for a personal financial statement, which is a very simple assets versus liabilities, what assets you have, what liabilities you have, and then it'll even out to your net worth. We're going to ask for a credit authorization so we could run a soft pull. And everything else at that point is really on the property. If there's any other information that we need for the property in order to qualify. Let's go now into the benefits. So the benefits and why it's, again, so popular. And I feel like I'm really honing in on this, but again, it's really important to understand the speed and the efficiency of the process is really one of the biggest assets for the deal. You're not going to be running around trying to get a document that needs to be on a PDF, not on this version, and send it to us through this, this way and whatnot. We make it very simple and easy to process the loan. We're doing the math is right there. So essentially what's going to happen is once we run a credit check and we know where your credit's at and we get the appraisal in, we know the terms, right? At that point, it's a lot simpler to understand and see if there would be there's going to be no last minute surprises or anything like that. It makes it very, very simple because we're not basing it off of 20 different calculations of your income and what about this line item of your tax return, which shows this. It's none of that, right? If the property brings in a certain income, the payments are a certain payment every single month. If we're hitting a certain ratio, we're going to be okay. There's no personal income verification. There's no hard credit pulls, right? So you're not hurting your credit by borrowing and leveraging yourself. And one other thing to mention, by the way, when you borrow from a traditional bank, that mortgage is going on your credit report. So if you have 10 different investment properties with a bank, you will have 10 different trade lines now on your credit report. Now, while there is a benefit to that, because once those are paid off, you'll have better credit. But at the same time, it actually hurts you in the short run because now you actually show that you have debt that you have taken out that is not paid off yet. So when you borrow a DSCR and you're borrowing from a private lender, we do not put trade lines on your credit report. So you will not see how many investment properties there are on your credit report. So if you now need to go and leverage your credit for your business, for material, or for anything else, you're not going to have that issue. And we will not be dinging it with a bunch of inquiries. So you also have higher LTV than banks, right? So we'll go up to 80% of the purchase. And this is specifically in investment properties, right? Because I know that there's, some guys that'll say, oh, well, I could house hack and get it for 3.5. But that's not scalable, right? That's using an FHA product and finding different ways through it. But again, we're talking about your traditional investment property options that are out there. There's no property limitations, so you can scale your portfolio and also the flexible and terms and competitive rates. You are not paying a crazy rate just because you're using a DSCR versus a bank loan. You're typically going to be a half a point to a point more than a bank. And in most cases, it's usually very worth it. And you're also usually going to refinance in the future anyways. So that's where we can get creative and structure some different prepayment penalty options, some lower or higher, depending on your strategy. That's where talking to your loan officer and really having an in-depth conversation is going to help you and help the loan officer really actually structure the best deal for you. And I do want to point out something that Steve just put in there. If you guys have any questions, please put it in the chat. I'm happy to stop and answer them. I want this to be very, informative, engaging. So if anyone has anything, throw it in there. And if I want to cover it later, I'll push it till after. But if it's something appropriate for now, we'll get right into it. So how do we qualify for a DSCR loan? The property must generate enough rental income to cover the mortgage payments, right? And we're going to go into the calculations on how that works. And now you also need a minimum credit score of a 650 plus. And you generally do need to have liquidity requirements, right? We don't want you to go purchase broke where you buy a property and now there's no money, where if a renter, decides to not pay 1 month, or he's late, or if you have a boiler issue, you're now unable to solve the problem, right? So we generally do want to see liquidity. Now, if you are doing a cash out refinance, we will allow you to use a percentage of that cash out as your liquidity, right? Because you're getting cash from this deal. So there's a lot of different ways of looking at that, but in the end of the day, we will kind of share with you what that looks like as we're building the deal together. Now, again, it's not a whole lot, right? If you think about it, if your monthly payment on a deal is $1,200, for simple math, let's just say $1,000 a month, we're talking about $6,000 to $12,000, right? So you should have a little bit of a cushion to help you out. And that's just a general rule of thumb. That's not even me saying this from a DSCR and a loan officer perspective. This is me saying this from an investment perspective. Like, you should have reserves at all times. You never want to be in a situation where you don't have the money to rectify a small issue that could then turn into a much bigger issue. And then your loan must be held in an LLC or corporation. Again, as I mentioned, there are scenarios where we can do it in your personal name. However, I don't really recommend it. And I always recommend that you talk to your attorney, an accountant, to understand, the benefits, how to structure it, what kind of corporation you would like to put it into, what makes the most sense for you and your family. So what are some of the common pitfalls and how do we solve them? Sometimes people are not necessarily calculating their DSCR correctly. Now, we also have a free calculator that you're able to use on our website. So if you go to Express Capital Financings, I think it's going through Canva, so it's probably taking in a little bit of a redirect right now. I'll let it load and I'll show it. Oh, there it is. So if you go to our website, it's also right here in the top. If you go to expresscapitalfinancing.com, you'll see deal calculators. We have one for fix and flip. We have one for our DSCR, where you can go down and fill out the information, how much you're buying the property for, whether it's a purchase or refinance, how many units it is, etc. And what you'll be able to do is start to calculate your deal right up front, right? I'm looking for 75 LTV. My loan officer told me rates today are about 7.25. I'm looking for a 30-year amortizing loan, and I'm paying this much in closing fees, and my rents of unit 1 is 2,100 and unit 2 is this much, so on and so forth. And as you go through it, at the end, you're going to get a PDF breakdown of the entire deal, your ROI, the DSCR, the monthly payment for principal and interest, the monthly payment for your taxes and insurance, your PITIA payments. It's going to break down the entire deal for you so that you actually have a good understanding if that deal does make sense for a DSCR or not. Another pitfall that we've seen is people buying ineligible properties. So remember, we're trying to find good investment properties, right? That's the name of the game. So I'll give you an example. One thing that usually comes up is, not usually, but comes up from time to time, is rural properties, right? We don't want to really finance a property in the middle of nowhere where there isn't a whole lot of other properties around there. The reason for that is because then you don't really know how true the value of the asset is. You may be lending more than it actually is, or it's not as easy to get a renter back in there. Because remember, we're lending on these properties based off of its ability to perform as a rental, right? So if I'm in the middle of the woods and I lose my tenant and it takes me another 2 months or 3 months to get a tenant, where is that monthly payment going to be made from, right? Now, we understand, a lot of investors, whether they have their job or they have their reserves where they can make the payment, but we don't really want to rely on that, right? So we want it to be able to be where you can get a tenant in there quickly and not have a problem. So typically speaking, I mean, again, from the rural perspective, like there are some properties that some people may categorize as rural that we would still do. But just for the purpose of this conversation, we're going to exclude rural properties. If you're ever unsure, feel free to send us an email with the address. We'll be happy to take a peek at it, let you know our thoughts on it. Most of the time it is based off of what the appraiser categorizes it as also, but we generally have a really good idea of, how that's going to look once it comes through. The next thing is running into delays. I can't tell you how many times I've seen other lenders try to close a deal quick and there's a pitfall because of this or that, whether it's a third party or whether it's the lender themselves. It's all about the streamlined process. So our goal is always to be efficient, right? We incentivize our processors, our underwriters, and our team to make sure that we close the deals quickly because we know how important that is. Now, you have time, no problem. Let us know your estimated closing date and we'll be ready to close on time. So now let's get into the real numbers, right? How do we calculate the DSCR? So the formula for DSCR is that again, DSCR is a ratio, right? So it's a ratio of the income to your expenses. So if I take my net operating income and I divide it by my total debt service, which is my expenses, I'm going to get my DSCR ratio. So for just simple math, right, we're going to use an easy one here. If I'm collecting $1,200 a month in rent on my property, That's after all said and done. And I'm paying out in principal, interest, taxes, and insurance, and any HOA fees, a debt service of $1,000 a month. I am at a 1.2 ratio, right? Because my income is one of the debt service plus 20% on top of it, right? So that's how we get the 1.2 DSCR. Now, what will we need to actually check the debt service of a property? We'll need a mortgage calculator, which you can use on our website. We'll need the income and expense details for the property, right? So income is the rents and expenses is the mortgage payments. So principal, interest. And if you're doing interest only, by the way, then you're only counting the interest. Now, just a quick piece on that. It might be a little bit too much, but I'll explain it anyways. We also do offer interest-only options. It was a lot more common when rates were really high. Now it's not as common. I wouldn't really suggest it as much unless the deal really, really needs it. But you can make interest-only payments, let's just say for the first 5 years. And then from year 6 and on, it turns into a 25-year amortizing PITI loan, right? So now you're paying principal and interest for the last 25 years instead of for the first 5 years. In those scenarios, we will check what the debt service looks like in the first 5 and the last 25 years. But if you're taking just an interest-only loan, then you're only going to take the interest, right? So it all depends on the loan itself. So that's why it's important to really understand what you're actually getting, what the mortgage payment is. And that's why we need the mortgage calculator. And then we'll need the property taxes and the property insurance. So here is a deal that I kind of put together, a simple one. Just wanted to share so we could do some math together and really break a deal down. So if I'm buying a property, here's the top portion of this page is kind of what we're using for this deal. So we have a property that we're buying for $250,000. We're taking a loan on it for 75% LTV, so we're putting down 25%. I got an interest rate of 7.5%. So my loan amount is $187,500, right? The difference is my down payment. The principal and interest payment on a $187,500 at a 7.5% interest rate is $1,311. The taxes on the property is $2,000 a year, and the insurance is $1,200 a year, right? So ultimately, my total monthly income is $2,200, right? That's my rents. My total monthly debt is now coming out to $1,577, right? Because I have the $1,311 a month for my principal and interest, and the taxes and insurance broken down into a 12-month payment is $267 a month, bringing me to $1,577. So now if I take the $2,200 minus the $1,577, I have $623 a month coming to me in cash flow, right? Right now, we're just understanding the scenario. We're going to break down into a few different ways. The first way, what we're going to do is we're just going to calculate the DSCR of the property. Now, just to show you guys, it doesn't matter if you use monthly numbers or annual numbers. They both work exactly the same, but you have to use all your numbers monthly or annually for it to work, right? So if I'm doing monthly, then every number in here is a month. If I'm doing annual, every number in here is going to be annualized. So my net operating income, which is $2,200 a month, divided by the $1,577 monthly payment equals a 1.4 DSCR. And if I do it annually and I take the $26,400, which is $2,200 times 12, and I take $1,577 times 12, which is $18,924, I get the same 1.4. It's really 1.39 and change, but I rounded it up because it should be a 1.4 at that point. So that's how we calculate DSCR. If anyone has any questions by any means necessary, please put it in the chat. Happy to go into it. If not, I'm going to move on to the next one where we cover what is an ROI and what is cash on cash. Now, I'm a little bit, I get a little bit involved in this one because there is a lot of, when it comes to real estate, we're all speaking the same language. I kind of compare it to Spanish. Like if I speak Spanish and I'm from Spain, I'm going to speak mostly the same, but different than I would if I was from a part of South America, right? Real estate is the same way. We all speak the same language, but we use a lot of different variations and different lingo than each other, depending on who we learned from and where it came from. So I like to be very specific and just be clear as to what I'm talking about and not just say a word like ROI and hope that everyone knows what I'm referring to. And why do I say that? Because when we're talking about ROI, people will use that as their people will sometimes use that as their cash on cash number. Whereas a lot of the commercial guys and people that are brokers even will calculate ROI is nothing to include based off of the actual cash on cash. It's just the property itself, what its ROI is. So it's important that we separate the two of them so that we're familiar with the both of them. And if someone's ever giving you a specific number or anything like that, just always try to clarify it and understand, is this based off of that? And we're going to go into that right now. So your ROI is return on investment, right? That measures how much money or profit is made on an investment as a percentage of the cost of the investment, right? So we're specifically looking at the cost and of the asset itself, right? Whereas cash on cash is used to measure how much money or profit on an investment of the cash invested in the deal. What's the difference? So in this first scenario, my ROI is based off of the income of the property, right? The 2,200 over the 250 that it's being purchased for. Whereas my cash on cash is my down payment and my monthly cash flow. How much money actually left my pocket and what am I receiving in from that? So we're going to go into now how to calculate that. It's actually extremely similar to the DSCR. Now, you don't necessarily need to calculate your ROI to get approved for a DSCR loan, right? This is a little bit irrelevant to the topic, but it's also very relevant to the topic because you guys are out there searching for deals. Now, if you're looking at a market where your typical, I'm going to use a different word here, cap rate, which is very similar to ROI, that's how realtors will usually pose it, is a 6%. And now you're buying the same property at a 3%. Well, you're not getting a great deal, right? So it's important to understand how to calculate that more for yourself and how, and when you're shopping to make sure that you're buying right in your market, than it is for qualifying it for a DSCR product. So to calculate each of these, we're going to take the percentage of the we're going to take the net profit or gain on the investment and divide it by either the original cost or by the cash that we actually invested in the property. And there we're going to get two separate ratios. One is going to be our ROI and one is going to be our cash on cash return. They are both technically a return on investment. That's why some people will call it a cash on cash and ROI. And it's just helpful to sometimes explain and just understand what it is. So for ROI in our original example, the deal is as follows, right? So the gains that I received is 23,200, right? How did I get that? I got 26,400, which was my annual rents. And then I divided my annual cost, which is my taxes and insurance, which is 3,200, right? So we got that here, the 2,000 and the 1,200. So it brings my gain to 23,200. Now my cost of the property was 250,000. Now keep in mind, for simple math, I am not including closing cost here. However, you should be adding closing costs to all of these equations. It makes it a lot more real, and that's the real number you should be looking at. Again, I just didn't do it for the purpose of keeping things a little bit simple. So now if I take the gain, which is 23,200, and I divide it by the cost of the property, which is 250,000, the ROI on this property is 9%, which means another way of saying that is they're selling this property at a 9% cap rate. Now, if I want to calculate the cash on cash, right? Now, cash on cash is different for everybody. That's why your broker may not be presenting that number to you. They're going to be presenting the ROI because they don't know what rate you're going to get, depending on what day it is, who you are, what your credit score is, etc. Right? So they don't know how you're going to finance it. Are you going to do all cash? Are you going to put 50% down? Are you going to do 80%? Are you going to try to, get a high cost loan just to get in and then refinance. So they can't present a cash on cash return. This is really for us to do for ourselves. So based off the same numbers from the original example, I'm going to divide the gain after my principal, interest, taxes, and insurance, and I'm going to divide that by the cash invested in the deal. So my cash invested in the deal here is $62,500. That is my down payment, obviously plus closing costs, but as we mentioned, we're not counting that right now. So I'm going to now take the gains. The gains are 7,476. How did I get that number? I'm taking the monthly cash flow, the actual money that I am receiving from the deal, and using that times 12, which is to give me an annual number for how much the deal brought me in a year. You could go about that differently. You could take your total of 23,200 and minus the PITI payments. For me, it was just much easier to just take the 623 and times it by 12 to get my annual gain. So if I take now the 7476 and I divide it by the cost of the 62,500 that I have actually put into the deal, my ROI is now 12%, right? My cash on cash return is 12%. I should have changed that. That's my fault. Now, why is this also so relevant? What should be some of the aha sparks that are coming off right now and you're realizing you will make a lot more money using other people's money, even though there is a cost of financing? Because now I made 12% on my 62,000 versus this person who bought the property cash made 9% on his 250,000, right? So now if I go ahead now and I spread my eggs in multiple baskets, and now I have I could probably buy 4 properties with that same capital, and I'm making 12% on each of them, I'm going to be in a much better situation. And even in a bad situation, if something happens to one property, I still have 3 others that are providing an income to help me with, right? Or maybe in the future, if I need them, I can leverage them, right? We also have appreciation and all the other benefits that come with real estate. So that's the difference between the two of them. That is one of the big ahas and why people like to use it. Even people that have liquidity still take loans. It's necessary in any growth model if someone is trying to build. There are definitely scenarios where it may not be worth it. Maybe, you're at that retirement age and you just want to let your money work and sit, and you just, don't want to go and find too many properties. Sure. Yeah. I can see situations for that. But anyone that's hungry and trying to build a portfolio, trying to grow and scale their business, it's always going to make sense for them to take on debt. And remember, there's a difference between bad debt and good debt. Bad debt is borrowing to buy a Lamborghini. Good debt is buying an asset that's actually going to provide you with cash flow, right? Those are good things, and we want to buy cash flow. So if you remember, we put it here again as well for you guys. You can use our DSCR calculator on our website. Our website is expresscapitalfinancing.com. And in the top right corner, you'll see deal calculator, where you could then go through and click on either the fix and flip or DSCR calculator. Now, how does all of this play in when it comes to portfolios, right? There's always going to be a investor that has, they own the block and there's 10 properties on that block and they're all rented and they want to keep it under one portfolio. Or maybe they're buying a portfolio. I've seen a lot of them. People are, so-and-so is retiring and moving to a different state and he wants to liquidate his portfolio and start his retirement. Great, no problem. Buy his portfolio and we could put it under one loan, right? So it's usually good when you're doing 5 or more properties into that portfolio. It's also better for the people that are not planning to be as, for the lack of a better word, flexible. And why I say that is you can still sell an asset while it's in a portfolio loan, but it's not as easy. You generally will have to pay a little bit more than the unpaid principal balance. So let's just say on this particular property, I borrowed $100,000. I may have to bring the loan down more than $100,000 to take it out of the portfolio to avoid the portfolio going underwater. But you can. right? So it's generally better though if you're planning to hold that portfolio for a while, right? You're not looking to sell one off or refinance one property out of it. If you want maximum flexibility that way, put individual loans. You'll see it'll be much easier to move through and just be flexible with. It's also, again, if you do have a lot of properties and you do want to be able to manage them easier and not have to worry about each individual loan, it does make it a lot easier for that, right? And we can put, 15, 20, 30 properties together in a portfolio at a given time. The only thing is that they do have to be under one LLC. So again, there's options for those that are looking to scale with a, one or two units here and there, or somebody that's looking to reconcile all their properties, or someone that's looking to buy a big portfolio. All of those are options. And we look at it the same way. We're looking at it from the portfolio. Hey, does this portfolio cover the debt from the rental income? And if it does, then we have options. Just to give a little bit of information on why I work with Express Capital, right? So number one, we're very happy to say we're very appreciative for being recognized by Forbes 2 years in a row as the trusted and respected best hard money lender of 2024 and 2025. We offer fast closings. We can get deals done in 3 to 5 weeks versus your 30 to 60 days dealing with banks. We don't ding up your credit. We only help your credit. Actually, we can do rapid rescores and other simulations to help you improve your credit in order to qualify for the best deal possible. And we'll only do soft pulls. We work with experienced, all of our team is experienced loan officers, investors, and focused on service. That's something that we take very seriously. Our Google reviews speak for it very, very loudly. Any deal that we take, we want to give it our best effort. We want to make sure that the investor knows exactly what they're looking at, how it looks, what are the pros, what are the cons, why is this the best option for them, and helping them navigate through it. For the more experienced guys, it's really making a streamlined, efficient process for them so that there's no mistakes coming through, all T's are crossed and I's are dotted, and making sure that the entire process flows. And we offer flexible loan terms and tailored solutions for you guys. So we understand the investment space extremely well, and we want to make sure that we are providing the best deal for our investors. So if anyone does want to get in touch with us, here's our information. They could go on our website at expresscapitalfinancing.com. They could call us at 718-285-0806 or shoot us an email, info@expresscapitalfinancing.com. We'll make sure that you get to a experienced loan officer that can help you navigate the deal, understand it. And I really, truly hope that, everyone was able to take something away from this presentation, something that they didn't know or something that they did know and just needed a refresher on that helped them feel a little bit more confident in their next deal. Maybe a deal that's on the table right now that they're looking at that they just needed to understand it a little bit better. We're always here to help and provide education. I appreciate, Steve with Real Estate IQ for always having us on this platform, allowing us to educate investors, allowing us to be a part of that process, because it really means a lot to us to see people grow. I can't tell you how many people we've worked with, day one, they were buying leads from Real Estate IQ, didn't know what to do with the deal, and now they're buying properties left and right, and it's really, really helpful. If anyone does have questions, I am happy to take that. Oh, wow. I didn't realize there was a whole different section for questions here.
Max, we have a lot of questions. So that means we have a really successful session, actually. Richard has a question about your example on portfolio loan. His question is, if you buy 5 properties in 1 year, you sell off 1 and put the money back into paying off the loan, how does that work with payments?
Is that the Richard? Okay, so if you buy 5 houses and in 1 year you sell 1 off and put that money back into paying off the loans, how does that work with payments? So the payment is now based off of the new unpaid principal balance, right? So Just for example, I bought 5 properties for 100,000 each. So I bought 5 properties with a loan on each property for 100,000 each. So I have a $500,000 loan. I sold off one of those properties for 100,000 to pay back, but the lender says, "Hey, no, instead of paying 100, you have to pay 120," right? What we will do there now is your balance, instead of it being 400, is now 380. So your payment is still the same rate, but it's based off of the new unpaid principal balance of 380,000.
Yeah, that makes sense. I noticed, within the questions, there are 3 really important ones, Max. One of them, the first one is, what is the minimum DSCR ratio that you guys would loan to?
That's actually a great one. So, and I'd like to preface this with just because I could doesn't mean I should. We could lend even on a negative DSCR, right? So we could do a deal with a 0.75, 0.5 DSCR. Now, as a loan officer, that gives me a lot of power, right? I could really easily put somebody in a very bad position by offering that to them, because now they're coming out of pocket every single month to make those monthly payments. So what it comes down to is having a conversation with the investor and understanding, is this really what you need, right? Now, are there scenarios where it makes sense? Absolutely. I've seen times where investors need to leverage their property more than they probably should, but because they're using that to buy a much better asset, which is going to be able to provide a good return on both the original loan and the new loan, right? I can understand that, right? I can understand when you're taking money out to I can understand that if you need to come out of pocket a little bit, but because you're getting it back from a different asset. But we can do things like that. We do have loans where, we could do it based off, like, even though it's still a DSCR loan, it just doesn't need to have a qualifying DSCR. Now, to get a decent rate in today's market, you should have a 1.1 or 1.15 plus DSCR, right? The magic number is 1.2. That's really where you're going to be at, a good everyday rate. 1.3 and above, you're starting to get better rates.
That's very good. Thank you. There's another one that's related. It's about season. Is there a seasoning period?
So seasoning period, yes. And let me explain the question behind that too, just for anyone that doesn't understand. So when it comes to seasoning, what he's asking is if I want to refinance or take a cash out on my property that I bought, right? How long do I have to wait till I could use the as-is value? So if I bought a property today for $100,000, but it's worth $200,000, can I borrow $150,000 on that property today? And the answer is no. You generally have to wait a minimum of 3 months. Most of the time, it's 6 months, right? We do have, for experienced investors, exceptions where we could go down to 3. 90% of the time, it's going to be a 6-month seasoning period where we want that property to season. We want to know that value held for at least 6 months before we go and give you a cash out for more than you purchased it for.
And do you allow, I saw one that asked, do you allow owner-occupied DSCR?
We do not. Yeah, so we only lend to investors. That's something that we very, very specifically do. We're not licensed to lend to primary homeowners, and our team is trained to look for that and not provide deals if it's going to be owner-occupied. The only owner-occupied deals that we offer are when it comes to commercial mortgages, where you're occupying the business, right? So maybe I own the retail store and the real estate attached to it, and I want to get a loan for that, then we could do owner occupied. But when it comes to residential, we do not do any owner occupied deals. I like that question that Richard just asked. Can I do a DSCR to self-directed IRA? So in a nutshell, if I'm not mistaken, an IRA, a self-directed IRA, is going to make sure that that the loan you take does not have a personal guarantee on it. It has to be a non-PG loan. The only non-PG we offer is the portfolio loan. So you could do use your self-directed IRA for a portfolio loan. Now, I also have heard, I don't want to speak for this. It's not something that I specialize in, nor that I know very well. But I have heard of ways that you can still take a PG loan using your self-directed IRA. And I think that's by using, whether it be a trust or different LLCs and having it owned by one. It gets a little bit confusing. I try not to spend too much time getting lost in that, but there may be some ways that you can do that. But as long as your IRA is not going to have a problem with there being a PG, we can do a DSCR loan using your IRA. These are not, the only one that's non-recourse, Richard, is going to be the portfolio. So a single asset DSCR loan is going to be a PG. He's also, you mentioned you don't do vacant properties. If you're buying a property, do rehab and then either sell or rent, would you fund that? Yes. So just to clarify this a little bit, Richard, if we're buying a property to do a fix and flip, we're probably not going to do a DSCR loan. We're probably going to do a fix and flip loan, where we're going to give you a much higher leverage. We'll cap it at 90% of the purchase and 100% of the renovations for an experienced investor. So you're getting both the purchase money and the renovation money. And then once that property is stabilized, we're going to refinance it into a DSCR loan. Now, while you are looking for a tenant on that property, so there's always going to be a gap in time, right? So I finished the renovations. Now I have to get a tenant, and now I have to do the DSCR. What Express Capital Financing is willing to do is fund it while it is vacant and it's on the market looking for a tenant. We're okay with that, right? When I say we don't do vacant properties, I'm referring to a property that's been vacant for 6 months. If you just bought it and you're looking for a tenant and it's on the market, or you just finished renovations, or a tenant just left, a week ago and now you're trying to get another one, that's okay. We will fund those deals. K Peck is asking, can you apply for a DSCR, get approved prior to 6 months so that when the hard money loan expires in 6 months, you are ready to pay and refinance? So the answer to that is yes. I always recommend getting pre-approved as early as possible. The more time you have, the better off you are. Now, starting the actual process for the refinance, we probably won't start it till a month before you're ready to go, because we want to close right away. And why do I say that also? Things change, right? So rates can be lower at that time, higher at that time, right? So it depends on where we're at that day as to what it's going to look like. So if I approve you 6 months prior, and, just for argument's sake, that day rates were 6.5%. And by the time we're ready to proceed, rates went up to 7.5%. And now it changes the debt service and the deal changes a little bit. I didn't really do you a service, right? So that's where it's always best to do it, about a month before, so that even when we lock in the rate, we're also able to make sure that we keep that rate, because the rate lock will expire.
So Max, what would be the logistics be? So, in this case, it's about, we're fixing the property and we are not able to let it, put a tenant in yet. So what's kind of the time frame to kind of bridge all these while the hard money loan has a kind of a expiration date?
Let me just make sure I understand. So you're asking me, like, what's the time frame between completing the work and getting it rented without a tenant that we can kind of do?
Yeah. Like, what kind of loans should we be kind of working on? So right now we have a hard money loan for the fix and flip. And then there's going to be a period where it's going to be vacant and there's no tenant. And then also at the same time, the hard money loan matures.
Right. So we'll fund that. We'll fund that right then, right? So as soon as the work is done, we can start to fund it, even though it's vacant, right? Well, the way that we're going to look at the DSCR for that particular deal is that the appraiser, when he completes the appraisal, he's going to complete a 1004, which is a rental comps, right? Mm-hmm. And on there, it's going to show us, based off of the comps, this property should rent out for $2,200 a month. That is now going to be the number that we use when we're calculating the DSCR. So as long as that works, we're going to fund that deal. Now, if like I said, the only time we won't do it vacant is when it's been sitting vacant. If it's a cash out refinance and your property's vacant and you haven't had a tenant, in a while, we're probably not going to do it. If you had a deal where, this is a little bit it's a little bit similar to like the fix and flip, where it's a common sense approach to understand like vacant versus not. Like we're going to look at it very common sense wise. If you just had a tenant move out and you put it on the market and you're in, New Haven, where it takes 30 days or less to get a tenant, sure, no problem. We have no issue with that. Tell me now you're in the middle of the woods of North Carolina and you're in a small little town and you don't have a tenant there for the last 2 months. We're probably going to say get it rented before we proceed on that one.
So we got this one, a request for rehab loans.
Oh,
do you guys have one?
Absolutely. We do. We have overworking with Real Estate IQ over the past couple of years. It's been a while now that we've actually started this. We put together a lot of different presentations, and we're always happy to educate on the different types of deals. We've done fix and flip. We've done how to find deals, how to structure deals, how to build a team. So we're happy to keep these moving and keep doing more.
Awesome. So we look forward to having that as our next topic. Okay, so we have time for one more question, and then the rest of the question that we couldn't field, what we can do. Max, what do you prefer? That we send you the list of questions and you answer them, or do you want to like record the Q&A piece, or do you want to type up the answer? What's your preference? And then we can send it off to everyone that attended.
If you can send me the questions, I can probably try to put together a recording with like some of the questions and answers. That I think that would be a lot of fun.
Yeah, sounds good.
And up to you, by the way, if you're open to it, maybe we could even do a live question and answer where we could just sit there and, take on all the different questions that come up and help people navigate their deals. Yeah,
I think we have one scheduled in March.
Yes, we do.
On March 20th, I think. So everybody put it down on your calendar and you'll receive an invitation too. All right, so we have one more question. We have time for one more question, guys. So Vincent says, I assume liquidity requirements vary based on the loan amount. So what is the breakdown for the 6 to 10 month reserve that you have on one of your slides?
So the breakdown is the PITI, correct? So you are right. You assume that the liquidity requirement varies based on the actually, yes and no. It varies based off the loan amount solely because we're looking for 6 to 12 months of PITI reserves, right? So it's not necessarily specific to the loan amount. The loan amount is indirectly involved because depending on the loan amount is how much the PITI is. The reason that we say 6 to 12 months is more because it depends on the product that we're using, whether it requires a 6 or 12 month reserve. Some of our products require 6 months. Some of our products require 12 months. And the reason why some of them may require 12 months is because they're a little bit riskier of a deal. Maybe the DSCR is a lot lower, so I had to fit you into a specific product that's going to require 12 months. Some of our products may even have built into it a 4-month interest reserve where you're not making payments for the first 4 months, which actually equals 5 months because the first month is 6 months because the first month is paid at closing. The second month you don't pay till the third month, and then you have 4 months already built in. So for 6 months, you're actually not making a payment.
All right, so our time's up. Thank you, Max. Thank you so much for joining us, and we look forward to having you back. For those of you that did not get your questions answered, we're going to compile that and send it over to Max, and then we'll send you the answers to you. And again, there's more Ask Me Anything in the next session with Max on March 20th. So make sure you mark your calendar. I got one more thing to share with you guys, which is our upcoming event. This is next Thursday at 11 a.m., same time, same Thursday. And we're going to be talking about mentorship. So this is a really cool topic too. So look forward to seeing you guys. And that's all we got. Thank you for joining us and have a great Thursday and rest of the weekend, everybody. Thank you, Max. We'll see you soon.